Okay, guys, we're going to go ahead and get started. We may have a couple people that wander in, but so we'll get them seated as they get in. But before we get started, we'll get rid of some of the basics. I think I told everybody the bathrooms when you first come in, they're out to your left-hand side there. So feel free to use the restrooms if you need to throughout the time we're together. If you need water or more water, there's a ton of it in the back. So feel free to grab that. And there's folders that you guys got. You should have got a couple, should have got one, and as singles you're going to get one as well. And there's sheets in there that as we go we're going to fill out along the way. And then at the end there's a survey that you'll fill out and we'll have you turn that in. Actually, that's my wife Jenny. She's my boss. Go ahead.
No boss.
No, I would love that, but you only give one thing for two people. I don't know what to do.
You can have one.
Yep.
Oh, okay, thank you.
So yeah, so we'll have you guys fill those out at the end.
Yeah,
But for now, tonight we're just gonna have a lot of fun. We're gonna go through a lot of details as fast as we can. We've learned to simplify it very well. The presentation you're gonna look at, I did not put together. I've been doing this for about 22 years. I work directly with the Social Security Administration. I'm actually certified with them. I was bored enough and read the whole book. And there's quite a bit of ways to file, hundreds of ways to file. There's actually over 500 different ways you can file for Social Security. Not that you never know how to do that. And we also had this built together by our legal team, our insurance team, and our advisory team, and our tax team. So everything you see get together is actually current as of today. So as you go through, some of these figures you may have watched on the news 6 months ago. If those figures are different now, it's because they're current today. Things change. So we want to put that together for you. But other than that, we'll just kind of dig into this. My name is Greg Piorkowski. That's my wife, Jenny. We've been doing this for, like I said, for about 22 years. My background is anywhere from serving in the Air Force for 10 years as a commission. I was with the Stealth Fighter Squadron and did that for 10 years. My grandfather taught me to either be self-employed or go in the military, so I've done both. When I got out, I became self-employed. So I've owned an insurance company for a very long time. From that, we actually grew into more going a different direction. When I got involved, I didn't buy a book of business like a lot of people do. I went out and used my hands and built, over 3,000 clients on my own. So we're pretty proud, we're pretty proud of that. We've had advisors over the years. Through COVID, we decided just to back off a little bit. And, God did some work in my life and we took some breaks on things and just kind of reorganized on what we were doing. So, my background anywhere, like I've talked about, we've gone from the military, owning a company. We do some public speaking through Chicken Soup for the Soul, if anyone knows who that book series is. We work with Youth for Christ, if you know who that is. My son and I speak for them fairly frequently. As an agency, we partnered up, so I look intelligent behind me, but I really just repeat what I'm told. I've got a law firm that works with us. We've got a tax team. We've got a brokerage team. We've got an insurance team. We've got the Social Security Advisory Board. So all that stuff is behind me that I can pass on to you. So if I look intelligent, it's only because they passed it on. I steal everything I know, okay? What my direction was a little bit different when we decided we've been doing seminars and stuff throughout the years, but when COVID hit, I wanted to actually change that whole thing, and we wanted to start doing community outreach programs. So we became a part of the National Council of Financial Educators, which is more of a teaching, environment of kind of what we want to do with folks, and we want to reach out to folks in the community. I don't charge anymore. I used to charge $500 to sit down with people as we would develop their estate plans. Just to sit down, it was $450. There's still a lot of folks that do that. I don't do that anymore. And from a planning standpoint, as we talk about Social Security and how that's a puzzle piece, really just a puzzle of what you're going to learn and how that works. I'm not going to sell you tonight anything. Hide your purses and wallets. I'm going to be real honest with you. I'm going to talk with you straight, and we're going to joke and have some fun at the same time. If you have questions that you can answer as a group, write them, ask. If they're real personal, write them down, and we'll set up a time to get together, because you might not want to talk about that as a group, okay? From from experience-wise, whether it's fortunate or unfortunate, I've handled settling trusts personally. I've been, I understand special needs. I was clinically dead for 9 minutes and had to learn how to walk and talk and breathe all over again. So I understand that part on what planning means and how life can change in a heartbeat. My brother, I pulled out of the water when I was 15 and he was 6'9" and became a quadriplegic. So I understand watching my parents go through planning or lack of planning and how Social Security worked and how insurance worked and how estates worked. And then my son decided to get into a car accident and a passenger in 2015, and Bronson took the side of his head off and put it in the freezer for 90 days, and we lived at Mary Free Bed for a while. It took him 2 years to heal. So I only tell you that because everything that I do as an agency goes into planning. So I don't have to stand up here and say, well, let me advise you on how to do this and never have a clue who done it. We've unfortunately or fortunately been through all that. So that's kind of, as I took this on, we wanted to change our path and do community outreach programs. Because I watched through COVID people going from a high dollar amount to nothing. From watching the news getting scared to coming to us wanting to buy life insurance when they didn't need to. I mean, as advisors, we could sell you a bunch of stuff because the news is scaring the crap out of you. You're gonna die tomorrow. They show up at our office, we need a ton of life insurance, or we need to do this. We don't do that. We wanna back you down and figure out what you need. And Social Security, as we started looking at that, became a bigger interest in 2008 and 9, when the market took finally a big adjustment that was about 2 years past. And we're about a year past our adjustment already. You know, the crystal ball will do what it's gonna do. But in 2008 and 9, that Social Security, people started asking more about it. And when do I claim? And when is it best for me? And how can I use that to now save part of my financial estate? And can I leave my financial estate alone and use Social Security? I'm a married couple, can I delay? So we figured out in 2008, I took a different direction and I wanted to learn how Social Security was important. And New York Life came into my office and wanted me to teach them how to do it on Center Street. Because when folks turned 65, they went to their advisors and said, teach us about Social Security, I'm getting ready to retire. And their advisor said, I don't know anything about it, it's not my job. It wasn't. You know, so I learned that this was a puzzle piece. And as we see now through COVID, I'm not gonna use that as a scare tactic. Please don't take it as that way. But as we're seeing through COVID now, people are really looking at Social Security as finally seeing it as a puzzle and not just an income. And how do we use it to protect what we got and can we put it together? So that's really what I'm here for, okay? We'll talk about that, all right? Obviously, we're here to grow our company as well. I don't have a sales pitch at all. I wear a suit because it's the first time I met you. If you see me in my office, I probably wouldn't be. But you're gonna get straight talk tonight. You're gonna get honest talk and we'll have some fun. Does that seem fair? Okay. And the one thing I want to ask you is write this down. Why did you come tonight? There's a survey sheet on the very back that you're going to turn in at the end of the night. Somewhere on that sheet, write down what's the most important reason you came here tonight to learn. Whatever that is, what's the specific reason you came to learn? Because at the end of the night, I'm going to ask you, did you learn anything new that you didn't know before, and did you learn what you specifically came here to learn tonight? So we want to get you involved in that. So I've kind of covered this. This is a little bit about us. I've had a big agency before. I was in Vicksburg for a long time, right next to Stubby's Train Depot. Big office, fancy. Nobody walks into an insurance office. An advisor shows up and they play cards and tell their wives they're working, and they go use the money to play golf. I enjoy helping people. Okay. So during COVID, we backed ourselves down while advisors worked independently. I trained nationwide folks from Zoom. The company that backs me, that I've been with for over 15 years, is the Annuity Architects. They do $10 billion a year in insurance business and advisory business. $10 billion. That's who backs me. And I've been with them for a very long time. There's about the company itself has 150 years of experience behind them with the people that own the company. My office is right there. That's where I live. I sold 20 acres out in Pawpaw, moved into town, and I just decided not to fight the real estate battle and just lay put right there for a while. So we meet folks either in our house at Bigby or in their house. I do Big because I'm Polish and it's cheaper to go there than it is Starbucks. So that's why I go Big. But that's kind of where we are. We're a 501c3 now. So, you know, that's why I'm not charging anymore to sit down with people. They ask, are you gonna charge them? And so that's why I don't. Now we're working as a nonprofit organization now, which has been a huge blessing. I'm not an accountant, I'm not a lawyer, I'm not a CPA. I know a lot about that and can advise you on it, but I would rather you have an accountant of your own. If not, we can point you in that direction. We're gonna talk about some things that, this is a busy time for us because accountants are calling our office right now. Because people have monies that are sitting in weird places that they're getting taxed on and they don't know why. And it affects their Social Security. That's the trick. You gotta keep that in perspective. As we talk about different things tonight, it all funnels back to how Social Security income gets taxed. Okay, so it is really a puzzle piece. It's not a pitch to do anything else. Okay, we really wanna do a whole education here. The workbooks we're still putting together, and we wanna make sure some changes, so as we get that put together, the key points we're gonna cover here in these slides, okay? So specifically, what is Social Security? Does anybody know what Social Security is? There's an acronym that it stands for. It's called a PIA. Everybody has a PIA, and that's what Social Security is. You know what that stands for? It's a personal income annuity. That's what Social Security is, because it's always been funded by. Everybody has a PIA, a personal income annuity. And I bring that out right away because a lot of people, they come to some events to learn, and when they hear the word annuity, they run because their neighbors, brothers, uncles, cousins that dig schools for a living had a bad experience with a variable annuity, and they told them never to buy one. Or they read Susie Orman's book, they got indicted by Edward Jones for embezzling money from an annuity, and they think they're bad. And if you have a pension, anybody have a pension? Well, if anyone's ever gonna get a pension, your pension's funded by an equity indexed annuity. That's what it is. Early on when I started my company, I was feeling big and important. My dad's an executive from General Mills, and I flew to Minneapolis, Minnesota to talk to their fiduciary officer. And General Mills owns Olive Garden and KB Toys and Red Lobster and Greyhound and Colombo Yogurt and Yoplait and all these different things. And I asked them, I said, how are you? I said, I want to handle my dad's 401k, but how are you guys going to guarantee my dad's income for life? How's General Mills going to do that? And the guy giggled at me and he said, we're not. At that time, we're going to buy a Fidelity and Guarantee Equity Indexed Annuity. We're going to own it. We're going to keep all the growth on it that makes about 5 to 7% a year. We're going to keep the interest. But we are going to give your parents the guaranteed income for life. And I went, oh, well, that's what I do. So you're telling me that my dad could have, somehow, he can't, but when he buys it, if he could have cashed that out, he could buy it himself, keep the interest, and have the income for life. And they said, well, sure. So in 2008 and 2009, when the market did something different, they started opening those options up. And so that's really what they are. So I bring that out right away. Social Security, it's income sources. These are two different things that people's, on an average, what we see of over 60% of the people in the nation today, 60% of their assets are from these different lists, okay? 401k, distribution plans, retirement, annuities, savings accounts, CDs, whatever they are. And 40% they're depending on Social Security. Now that's not everybody. I have some people where that's backwards. I have some people to where they're 70% they're using for Social Security, and 30% is what they have. I have some people that we talked with on Friday that 80% of their income is this, and 20% is from a settlement from a pesticide. So they wouldn't have had that unless they didn't get a pesticide settlement. Okay, so wherever your situation is, we're going to show you how Social Security is a puzzle. And how if you were to ask me right now, Greg, when am I supposed to draw Social Security? I'd tell you, I don't know. We haven't sat down and talked. I can't give you an answer. I'm not going to stand and give you an answer just to look cool, and hopefully you'll talk to me. I want to be honest to you. And I don't know that until we learn about what the details are. So, will Social Security benefits be there for you? Again, I have no clue. Now, on a different side of it, if you read your Social Security statements, if you don't get your Social Security statements in the mail anymore, it's for really one reason. You started an online account, and as soon as you opened an online account, they stopped mailing it to you. There is a little print that nobody would read that says we're gonna stop mailing the account based on that, it's on the bottom. So if you're not getting your statements anymore and they stopped, that's generally the reason, okay? Or if you didn't change your address, that's kind of a limited one, then you could go update your address. But we're gonna give you the information tonight, if you're not getting it. But on your statement, it's gonna show you the different examples that we'll talk about later of when Social Security is expected to bankrupt for you, if it doesn't change, and what it looks like for different full retirement age dates. Okay, but it's on the statements. It tells you right when they expect to bankrupt if it doesn't change. For me and my wife and I, you're gonna think this is, I mean, you guys are probably a little bit different than me. I'm just now turning 50 in March and I think I'm getting old. But my wife and I are not planning on Social Security. If it shows up, it'll be a bonus. I mean, that's just how we're looking to plan, because I don't know where it's gonna go. For you guys generally in the room, I don't think personally you have too much to worry about. If I take my advisory hat off and talk to this Greg, I don't think that you have too much to worry about, but if you look at the statement, it'll tell you when they expect it to bankrupt, okay? The history on Social Security, just really fast. Item A. Fuller was the first one to get a Social Security check for $22.59. Wouldn't that be exciting? FDR set up Social Security. Did you guys know that? That president set up Social Security. He was the one that really started it. And she got her first check for $22.59. How would you like to have paid into it and just get that in your mailbox? Knowing that 40% of your income is going to depend on that. That's a little different. But really quickly on Social Security, will it be enough for you? That what you're going to get, is that going to be enough to work with what you have? And if it's not, then you have to figure out a different math. And if that's not going to be enough, we have to protect what we have here. And if we just hope that that's in the market, and we just hope that the market doesn't take that away like it did in 2008 and 2009, we don't know if that's going to happen. Not everybody lost in 2008 and 2009. A good percentage of people did. But if your future's based on hope, if that's your retirement plan, then it's not a safe plan. Hope is just simply hope. It's a good thing to have, but it doesn't define a direction of definitive. Okay, so you don't want to plan on that. What other sources of income will you have in retirement? That, you're going to want to look at that as well. I got Social Security as a puzzle. That's a piece. I've got retirement. Maybe I've got non-qualified money in the bank. Maybe I've got certificates of depreciation. Otherwise, we know with CDs. Maybe we've got money sitting in the safe. If you're like my mother now, who's probably got tons of money sitting around the house stuffed in turkeys and under carpets and in curtain rods and everywhere else, you don't want to depend on that money either. People still do that stuff. They're hiding around doing this. Whatever money you got, is it going to be enough? And and for Social Security itself, are these sources guaranteed to provide income throughout your retirement? Now, this is one thing I want to caution you with. We work with the largest brokerage company in the world, BlackRock. They are the largest broker in the world. Everyone falls under them. Edward Jones, Merrill Lynch, all that stuff. They all work under them. Okay? And when you look at a brokerage statement, you've got a 401k, a 457, 403b, all that stuff is still IRA money. It's just different: policemen, firemen, teachers, civilians. All is the same. It's still IRA money. It's all tax free. If you look at your statements on some little railroad, are going to say along the way, it'll say what your income would look like at a certain age. And it's an estimate. And I've had people bring to me their statements and go, well, Greg, I don't need to get a guaranteed income. I got my 401k. And I go, that's not a guaranteed income. Well, my statement says that. Your statement says if you don't lose any money, that's what it could look like if it continues to grow at that level. So if you don't have a pension and you have 401ks and a bunch of the savings, the only guaranteed income you could look to have would be Social Security, because everything else isn't guaranteed. Those figures are not guaranteed. They're just, I hope. And some people have a large hope. And some people have $4 or $5 million in their 401ks. Some people have large accounts. Those are large hopes. Okay, but they're, you've got to figure out how much is guaranteed income for life. How much do you have there? Okay, And the reason why Social Security kind of has a different idea is because it was built on a three-legged stool. It was only designed to ever pay out for a couple reasons. It was never designed to pay to everybody who paid into it. It wasn't built that way. It was built for all of us to pay into it, and then only if you got disabled, temporary disabled, mentally, disabled, I have a special needs son. It was only designed for those people, either for temporary needs or for permanent needs. It was never designed for everybody to get, even though you paid into it. It didn't have that fourth leg. We built it on three legs. So then later down the road, different presidents and offices changed it, and that's here or there. It doesn't matter. And then somewhere along the way, it said that all of us deserve, we've all paid into it, by gosh, we're all gonna get out of it. Well, that would have been great if we had four legs. We only built it with three. And we can't go back and build a new one. We'd have to change so many things. Cut Social Security checks, raise payroll taxes, raise taxes. We'd have to do a lot of stuff to do that. So that's why right now, there's many more people drawing from a bucket that are paying into it. And that's why it's in the situation it's in. It's not about fault at this point. It's about controlling. My grandfather used to teach me, control what you can control and deal with the things you can't. We can't control what's happening with Social Security. It is what it is. We can't change it. But we can control what we have at home. That's what we can control. And how those puzzle pieces are gonna fit together. That's what we can control, okay? So, going forward, will I outlive my money? If any of you have a concern of will I outlive my money, and you're sitting here, and you don't have to raise your hand, then the plan you have in place isn't the right one. Let me give you an example. I had a lady that reached out to our office. She called our office. I'm not going to give names or anything, it's just an example. My wife and I were talking about this today, and I get a lot of these examples. She called our office and said, hey, I've got $150,000 in a 401k. I have a small pension, and my husband doesn't like annuities, because there's over 400 annuities, Greg. There's only 3, okay? And I said, well, tell me what you're looking for before, because if no one wants to buy it, I don't sell those things. What you do, if you don't want it, you just don't want it. She said, Greg, I want a vehicle that offers a guaranteed principal, a safe return, and I don't want my money to ever go backwards. And I want to get access to it if I need to. I said, okay. I said, do you need to lump sum that money out over the next 10 years? Or do you just need income or some withdrawals? She goes, I just need just income and some withdrawals. And I said, so what are your goals? She repeated them back to me. She said, I don't want to lose any money. I want a safe return. I want a guaranteed income for life. And I want to use it for a pension down the road if I need to. I said, great. So we set up a time to get with her and her husband. And I told her ahead of time, I said, now listen, are these your goals or are they somebody else's? These are mine. I said, okay, well, let's talk to your husband because he's got a different viewpoint. Let's make sure you both get together. And I said, now keep in mind, where is your $150,000 sitting? She said, well, it's at the bank. And I said, what's it at? She said, it's at a broker's account. And I said, well, I don't mind who you talk with, but if you go talk to your broker, and you tell him you want to move the money, do you think he's gonna agree with you that that's a good idea? Probably not. Probably not. So I said, so I'm just openly telling you that. Oh, no. It's my money. If I want to do something with it, gosh darn, I'm going to move it. And I said, hey, that's fine. Call me back. So we had a time to set up. She calls me back, and I talked with her today. She said, Greg, I talked to my bank. Annuities are horrible. She said, if I put my money in now, I can't liquidate it in 12 months. I said, you're right. Unless you bought a 1-year annuity, which rarely people ever buy. I said, but did your goals change? Well, no. I said, well, what do you want to do? She said, well, if I can't liquidate it in 12 months, then I don't want annuities are bad. And I went, okay. So I figured out, the example I get to that, I said, Diane, somewhere along the way, somebody changed your goals. I didn't give you your goals, you gave me yours, but somebody along the way changed them. Well, my broker said it was a bad idea. Okay, great. So the example of that is as you learn about Social Security and you learn about your estate, all of my 3,000 clients were with somebody else, and I worked with other people. But don't make them my goals, don't make them your neighbor's goals, don't make them your broker's goals. Make them yours, because things change. My son used to be able to have right peripheral vision. Now he doesn't. My brother used to be able to walk. He's a quad. Things change out of your control. But the change that affects you doesn't affect anybody else. So keep that in mind, okay? Keep that in mind. So will I outlive my money? I don't know. We'd have to sit and talk. 59% of people in America today are worried that they're going to outlive their money. For whatever reasons, okay? And they're very worried about not being able to maintain their current standard of living, much less enjoy their retirement. Now, the biggest thing I see is when people come in and talk to me about Social Security, and they say, Greg, I'm retiring. I had a couple that was here the other night, he's Dutch and she's Polish, so they're really gonna want to pinch pennies. He said, Greg, and I'm Polish, and my parents have some Dutch in them. They said, Greg, we wanna learn about Social Security and tax deferrals so we can pinch some more pennies out of this. And, I asked him, I said, are you worried about how much money you're making? He goes, no, I'm worried about how much I'm keeping. And I said, why? He said, because that's what I live on. Now, I'm all about getting a good return. I'm all about seeing growth. We'll talk about having growth with Social Security, how to defer it. But most people, they reach about 65 that you guys have taught me over the years, that most people aren't worried about how much they're getting. They're worried about what they got, because what they keep affects your spendable income, which affects their lifestyle. So again, things change. How does it change for you? Okay, that's where we got to understand where Social Security fits. There's 3 pieces to the puzzle. There's determining what your Social Security benefits will be. And that can vary based on your situation, based on your age, based on you're married, you're single, but once you make a decision, the only way to go back is if you've been in it 11 months and you go back and pay them all back and start over. We'll talk about that. That rarely ever happens. So once you choose an option, you're in. So you want to make sure you choose the right one first time, okay? Understanding what options are available to you and maximizing your retirement benefits. The only thing I can tell you is having someone that can help you go through this. I can tell you, having a special needs son, you're not going to get an appointment in the Social Security office. I know the director down there, I've known him for 10 years. But right now, you're only going to get a phone call, unless it's a super duper emergency. And calling them and saying, can I understand what options I'm supposed to have is not a super duper emergency. And they're generally going to refer you to the website. So having an advisor to help you figure that out is not a bad idea, okay? And maximizing your lifetime benefit. There is a lifetime benefit for Social Security, and it's a guaranteed income for life. But I'm going to show you examples tonight that you can make an extra $150,000 on 9 different case studies that are actual case studies, depending on how you chose, okay? On how to maximize that. Your Social Security statement. Okay, this is what we talked a little bit about. If you're getting paper ones or printed one, they're going to look like that. And if you flip that over, that's where it's going to tell you when Social Security, decides it's going to stop. If it keeps going its path, it's also going to tell you what your full retirement ages look like, and what your time of horizon looks like, and what your income will be. If you keep on that payment credit, if you keep on that payment, that's another if. If you're looking at that example, and you're 4 credits away, and you decide not to work anymore, well, that statement, somewhere along the way, isn't going to be totally accurate anymore. That can change. But only you changed it. They didn't, okay? So, but generally that doesn't happen, okay? So it shows how much your employer paid into Social Security and Medicare taxes. It's going to estimate your retirement benefits based on retiring at different ages. And we'll go through that tonight. And a lot of that's changed. The laws have changed from even 2 years ago. I've been doing this for a long time, and it's amazing how they've changed. In the beginning, Social Security was never going to be taxed. Do you remember that? It was never going to be taxed. And then it was said when it goes into the bucket with your other income, it's like pouring water into one bucket. Social Security, 401ks, non-qualified money, tax, and all the different stuff, CDs. That whole bucket now gets taxed. But originally it said that when it goes into the bucket, Social Security has its own little pocket, and that was going to be safe. That changed. The only way you won't pay taxes anymore is if one of the clients I'm working with has got a pesticide settlement. their only income they get is Social Security. And because they had to put a large amount of their money into an annuity, because if they didn't, their lawyer and their tax accountant looked at it, and they were right, said it was gonna drastically affect their Social Security, because they weren't used to paying taxes for 10 years. Now they got this settlement, if they put it into the annuity, it sits to the side, and they can draw as they choose, rather than lump it. So they don't pay any taxes, because their only income is Social Security. So if you wanna avoid paying taxes, give up all your income and just live on Social Security. That's really the only way when people ask me, how do I not pay taxes? That'd be the only way to do it. You know, that's pretty much it. But other than that, we wanna show you how can you reduce taxes on one end to help reduce the taxes on Social Security. It's all one bucket, okay? There's the website that you can go to, so if you don't have an online account, that you can get one, okay? And it's really simple to understand. And if you logged on a couple years ago and you forgot your password, you can go on there and say, I forgot my username, click, and it'll go through stuff. I forgot my password, click, and it'll go through stuff. It's real simple to go through, okay? It's not that tough. Now, after you get logged in, then that's where it can get interesting. If you're going on there's software that if you know how to manage on there, it'll tell you how to do estate planning, how to do tax planning. It's all in there, but it's, if you're not what I do for a living, it may be Greek. Like if you asked me to read a set of blueprints, Daryl, right?
Yeah.
I wouldn't know what to do. I'd tell you there are a bunch of lines. Where's the garage? You know, I'm not an architect, so. Eligible versus entitled. Okay, these are some big words right now. That as far as Social Security, they're pretty talked about. An eligible worker is one who has accumulated the minimum number of quarters of work for Social Security benefits. Now, are there any accountants in here? Financial advisors, bankers, lawyers, any of that stuff that would understand this with me? Nope, I'm by myself. Darn. Guess I gotta explain it to you, don't I? Here we go. Eligible, that's what that is. Most all you guys are probably eligible. How many people already, has anyone drawn Social Security already or no? Good, you guys came before me. All right, good, that's good. Now the next one is you're at least 62 years old. That's when you can draw. Now it doesn't mean you have to. This is around, I'm gonna repeat this goofy phrase I came up with a long time ago. Just because your neighbor's brother's uncle's cousin who does school for a living, that says he's a good financial advisor, told you that he drew Social Security at 62 because the government's gonna go bankrupt and you gotta get your money. You don't file it off of fear. And maybe it worked for him, but that doesn't mean it's gonna work for you, okay? So make sure what you do is for you and not for off a different suggestion. An entitled worker is one that has applied for benefits whether or not they are receiving the benefits or have suspended them. We'll talk about file and suspend. That can be used very well if you're a married couple, okay? There is ways to do it as a single person, but that's not really, yes, no, sometimes it doesn't make any sense to do that if you're single. But as a married couple, there's some benefits on how you can leverage your Social Security, okay, file and suspend. Is anyone here government workers, railroad, firemen, policemen at all? Okay, that's what this is gonna reference, their type of Social Security, the windfall elimination period and the government pension offset. Okay, so if you're not in that, we'll just kind of go through that. The only thing that's similar to that is I've got a lot of clients that work at Ford or GM, and I've got a lot of relatives that I handle their estate. And when my uncle retired, I remember he came to me, he was all excited, he got this large pension. And then when he turned 62, he's the guy that's gonna get it because the government's gonna steal his money and they're gonna go into bankrupt tomorrow. So he had 62, he didn't even call me, he just filed his Social Security. And what happened was Ford had been paying him into his pension what Social Security was gonna be exactly. So when he turned 62, without him knowing it, Ford deducted out of his pension the extra because they told him he had to file Social Security at 62. And they just picked up the difference and it was the same. That's how Ford did it. That's a type of offset pension that Ford and GM did for a long time. Okay. Now what? Does anyone understand cost of living adjustments? Anyone? Bill, do you understand cost of living adjustments, what that is?
I know they had a really big one this year, so.
I did. Do you know why?
Yeah, right. We assume because of inflation.
What's the normal cost of living adjustment that Social Security is supposed to get every year?
It's been pretty low, probably over the last 10 years or so.
What's it supposed to be? This is where a lot of people don't realize it. 4%. They're supposed to get 4% every year. We haven't seen that for over 10 years. You've seen it this year. So we're gonna talk about, but the cost of living for Social Security, originally when put in place, and hasn't been changed in the books, is 4% a year. Now, if you talk to the average Joe, they'll tell you 2. Some people will tell you 2.5. But in the books today, still written down, it's supposed to be 4% every year for Social Security. This year, there was a bump where it's over 5% now total. They took a 4% jump this year. We can all figure out why that is, okay? But next year, watch what happens, okay? Things are called hiccups for a reason, because they come up real quick and they go back down, okay? So we'll see. The claiming age, you know, that's gonna be a trigger as to what works for you, what age do you claim. We'll talk about full retirement age tonight, and that can be different based on your birthday. Some of your full retirement ages, your FRA is 66 and others are gonna be 67. But you can delay till you're 70, but it's not worth the growth. You're not gonna get that much. And there's certain financial situations that I'm not gonna go into all the details on. If you have those questions, we can sit down, but there's rare situations to where if you're 60% of your assets are higher and you really don't need Social Security, that only in that situation would it make sense to stretch it out for 70, and it has nothing to do with getting extra money in that example. It's just not taking it for as long as you don't need it. I have a friend of mine in Akron, Ohio, that for a while he had Social Security checks sent to his house, and he had 12 of them in a desk drawer. And Social Security called him and said you have to cash them. He sent them back twice because he didn't want to cash them. They actually had a guy come to his office. His name is Jerry Dunn, and he's 82 right now. Makes a lot of money. The guy from Social Security came to his house with the lump sum check and said, "You please need to cash this." They drove him to the bank and he largely deposited because it was screwing up their accounting books. That's the only example I can ever tell you about. But that might be the only example that I've ever seen where, like some of the Pfizer folks I work with, or Armstrong, that they just didn't need it and they wanted to stretch it out. So there are situations. Working after making your claim, there's different incomes that you can make and different penalties you have. Once you reach your full retirement age, there's no penalty. After, actually, it's specifically, I had a gentleman here the other night that was very detailed, and it's after your full retirement age that you can actually work with no penalty. Up until your full retirement age, you're still gonna get penalized. The wording is very specific. After you turn 67, not the day you turn 67, you're still in your full retirement age at 67. After you turn 67, you can then make as much as you want. So there's a period of time. You have to go after, okay? The wording is really tricky. It doesn't seem fair, but it's the words, okay? The taxation benefits, you gotta figure out how Social Security can either hurt you or help you, or how you can not get taxed as much on Social Security by reducing some of the other areas of your life, or by redirecting some of the areas of your life. For example, I had a gentleman that he's got $250,000 sitting in a bank account, just sitting there. And the accountant called me and said, "Listen, Greg, I'm not a financial advisor. People come to me and they're asking me how to reduce their taxes on their Social Security, and I can't tell them anything because I'm an accountant." So when he called me, I said, "Listen, what's your financial situation looks like?" And we learned everything and got all the pieces, got kind of like an x-ray, kind of like when my son busted he got in that car accident. They just didn't go and cut his skull off and put it in the freezer. They gave him an MRI, an EKG, an x-ray. They wanted to see what was going on first before they cut that side of his head off and put it in the freezer for 3 months. They just didn't do it. They had to kind of x-ray. So we x-ray our clients and we see what it looks like. And I looked at it and I said, "Well, listen, John, what you can do, now that you said you're not doing anything with this $250, it's just sitting there, and you said you need to get a couple $100 a year from that. It's not tax deferred, you get that, right?" "Yep, I know that." "Well, if you put that into an equity indexed annuity, now it becomes tax deferred. And by all tax laws, you can leave it there forever and never have to touch it. But if you need it, you can grab it. There's a lot of options. So we moved that over, and his 250 went from the right side of the taxes on the 1040 to the left side. Now it's tax deferred. And he can leave it there forever. There's no tax laws that says you have to take it in 72 hours. So in his situation, it lowered part of his tax bracket by simply moving money from one pocket to the other. But it's gotta be the right move, okay? It's gotta be the right design, okay? That's why we're called the annuity architects at our company, because we personally know the developmental teams at the top 5 insurance companies in the United States, because of the experience that the company has. That's why we do $10 billion of business, working with Social Security. So the goal is to figure out how to lower the taxes on Social Security, and how to use that and not just spend it. Because for so many years, people just wanted to spend Social Security. It was kind of like winning the lottery. So we want to figure out how to use it and not just spend it. Because I think with what's going on right now, and again, I'm not experiencing this, God's blessed me, but I talked to a gentleman today down in Tennessee, outside of Lansing. I talked to a lot of people there. Outside of Lansing, 81 years old, and he said, Greg, in the last 2 weeks, I've had 5 people that either in my circle of friends die. Anywhere from 48 to the same age as him. So planning and legacy planning becomes another thing. Because here's the other thing. If you're married, a lot of people, I was talking to a couple of different ones, that the husband forgot that when he dies, that his wife is gonna lose a Social Security income. Because you only get to keep one. He had the full working hours, she's drawn half of his, and half doesn't really mean half. If he's drawn 2,000, you think half is 1,000, it's not. It's like 875. It's the new math, how somehow 2 and 2 is 5. I haven't figured that math out yet. But it's somehow new, I don't know. But so to figure out when that happens, how do you replace that income that she lost, or that you lost, with vehicles that you have that are just sitting there? Again, it's that puzzle. So you gotta, that Social Security brings up a big thought. Because, it's not gonna be there forever. Spousal benefits, we just talked about that, common claiming strategies, and we'll talk a little bit about that. Now this is the COLA, this is actual figures from today moving forward, okay? Not last year, don't know what next year's are gonna be, but you can see this is supposed to be 4% every year, okay? That's what this year, I think you were right, somebody said 5%. It was 1.3 last year, it's 5.9 this year, so it raised 4.6% this year. But you can see what it's been prior to that when it was supposed to be 4. It took its actual growth this year. Okay? So your claiming age. The earliest you can draw is 62. Now outside of that, there are some special needs situations where you can draw. But that's Social Security disability and things like that. We're not going to talk about that. We're just going to stay on Social Security. Okay? At full retirement age, we've talked about this, I kind of prepped you a little bit, FRA, full retirement age. If you were born between 1943 and 1959, your full retirement age is 66. That means your Social Security benefits are pretty much maxed out. And you can work full time and not screw up any of your Social Security after full retirement age. Okay? Now, if you were born from 1960 or later, then your full retirement age is 67. Question?
What's this year-old talking about 66 in 6 months? See,
I'm going to get into that.
Okay.
That's a great question.
Okay.
Matter of fact, let me get through this and I'll answer that, because I have a client that got stuck in that example.
That's where I'm at.
Okay? All right? But that's your full retirement age. Now, there are some details that if you read on your statement, and most people don't, and most of us don't read the stuff we get in the mail. We don't. I do, because I do this for a living, and I'm just a junkie mail reader, because stuff's changing, but not everybody does. What is your name?
Roland.
What Rowan's talking about is I had a national client that came to me a few years ago, and he talked to his neighbor, who told him to go file Social Security. And he filed at his full retirement age of 66. He called the office, went in and got an appointment, filled out the application. His full retirement age period exactly was 66 and 4 months. Exactly. okay? But the agent he talked with, they aren't gonna tell you that. Why? Because they don't know. They work there, but they don't know. I'm friends with the director, they'll tell you that. Why don't they know? Because it's not their job. Because if they tell you yours is 66 in 6 months, now they become a financial advisor. And they're not licensed. Because they're advising you to do something with money. They can't. It's not their job. They can give you a brochure and say, Rowan, go ahead and read that, your answers are there. You may read that and may not understand it. You may read it and understand it. Now you can come back and go, this says 66 in 6 months, what does that mean? Now they can answer your question. Because you asked them, what does it mean? But if you go, well, when should I file for Social Security? Rowan, here's a paper, it'll talk to you about your different options. Next. They don't know. It's not their job. It's like when New York Life came across the street when I had a small office on Center Street. New York Life was around before the SEC came in and shut down 75% of their assets because they could no longer sell variable products to people over 55. I was getting a lot of their business because you'd go over them and say, Mr. New York Life broker, I've been with you for 10 years, 20 years now, I want you to show me how to do Social Security and I retire. Clue, so they walked over to my office. So they wanted me to work for New York Life as a contractor, as an agency owner, imagine that, and teach their employers, their agents on how to deal with Social Security. Again, the example for that is, New York Life didn't do anything wrong. That's not their area of knowledge. It's not what they were taught, okay? So you gotta go where you can be taught, that's all. The latest is 70. Now we're gonna talk about some examples here, and I'm gonna stay on time, because last night I went too long. So here we go, or not last night, but Tuesday. So we're gonna talk about reasons, if you draw at age 62, there's goods and there's bads. There's pros and there's cons. Okay, there's a pro and con to everything, okay? You receive benefits earlier, right? If you draw at 62. But the cons is it's a smaller check. Now let me talk to you about that. Let's say that this bottle's full. And it's the same bottle at 62 that it would be at your full retirement age. Okay, if you draw it at 62, and and we talked about earlier before how there's an estimated span of life that the insurance companies have spanned out, and that's who's paying your Social Security benefits on a personal income annuity. Okay, so they take what your average span of life would be, and at 62, if they know you're gonna live to X amount of years, if it's 88, if that's what if they have you picked at, they have to pour your bottle out at that speed of 88 years old. And if you live past that, then they just keep filling it up and you made more, okay? But now if you draw, and I mean, this is where people think, well, if I draw it here, I'm gonna make more money than what I would if I draw it at 66. No. Because at 66, at your full retirement age, your lifespan is still estimated to be the same. So now they have to pull your water out faster. That's all. It's the same bucket, it's the same water, they gotta pour it out at the rate of what your lifespan is. Okay? So there's some really misnomers throughout the years. There's a rare chance to where you'll live past your average life of living. The human body's designed to live to 120. That's why I think David said he's seen on policies with insurance companies, it goes to 120. And after that, they just pay you out. Some of them only go to 100. That's why, okay? Social Security doesn't do that. They go based on what the average lifespan is based on your birthday, okay? So that's what that is. So let's get kind of going through this. Possibly there's a reduction in penalty if employed. So if you're still working, okay, and you take Social Security 62, it's not possible that you're going to be penalized. You are. We just don't know what the penalty is going to be based on what you're working. The penalty is going to be, the percentage is going to be the same. The dollar amount can be different based on if you're working part-time or full-time. Okay. The pros, if you wait to your full retirement age, which is 66 or 67, you could get a higher monthly check. Now the puzzle here is this. I'll give a little bit of the secret away. This is where I come in as an advisor, and I can learn about your situation and figure out what puzzle we need to lay down. Do we need to lay down a higher Social Security check? Or do we need to lay down a lower Social Security check based on what your whole picture looks like? Okay? No penalty if employed. because you're past your full retirement age. You can work. A lot of my guys in retirement, once they hit that age, especially at Stryker, I knew a guy that went, Stryker, he went back 4 times after his full retirement age. Went back as a contractor. Last time he went back, he bought his wife a convertible Camaro with black stripes down the middle and yellow. Purposely went back just to pay cash for that. But he went back 4 times after his full retirement age as a contractor, because it wasn't gonna bother him. He waited till then, okay? The downside to it is there's no benefits from age 62 to your full retirement age. Now, the only reason that would be a downside is if you remember that circle of 60% of assets being used and 40% for Social Security? The only downside would be is if you were at that circle that flipped, is if you needed 60% of your life to be funded by Social Security and 40% to be funded by your personal assets. Then you may not have a choice but to file at 62. Okay, it just depends how it looks. And at 70, that's the highest monthly check. There's no penalty if employed. Okay? Some important definitions. We're going to go through this because I want to get to the important part. The more important parts here. We're going to go through 9 case studies. And I'm not going to show you all of them. You're going to get caught up in details. We're going to go through 3 of them. Okay? Of actual examples of what it looks like. Okay? So deemed filing. You're going to hear these terms now. Okay? They've been used for a long time. It requires the claimant filing any benefit before your full retirement age, must file for all benefits available to them at the time. It's deemed now that you have to file. Okay? Restricted application is available to workers who have reached full retirement age and allow them to restrict their applications to just one of the benefits that they're eligible for. Okay? Again, these are situations that as we sit down and talk, I'm not going to know if you're in that until we talk. There's specific terms that are going to, when we learn about what your Social Security and your life looks like, if these deemed filing or restricted applications are something you have to deal with. Okay? Like I said, there's over 500 ways to file Social Security. I'm not going to go through all that tonight. Okay? Voluntary suspension is available to workers who have reached full retirement age, file for benefits, and simultaneously suspend the payments. That's something that if you're married that we can talk about. Okay? When should you start taking Social Security benefits? I don't know. Just like the doctor didn't know if he was going to have to take my son's skull off until he did an x-ray. Until he knew the situation and knew what was going on. That's when he knew what he could say that needed to be done. Okay? So once we sit down and talk, and we learn about what's going on, how Social Security can benefit you in whatever way it's going to, then you'll figure out when you need to file. Because here's the kicker. If you file for Social Security, and you maybe on your own you could do it. I'm not saying you couldn't. But I'm saying that's kind of giving yourself a root canal if you're not a dentist. Because if you make one mistake and you file, you're in. You're done. There's no do-overs unless you can afford to pay it back.
Exactly. I think, isn't there a possibility to pay back?
There's only one example I've dealt with in 22 years. And the gentleman worked at Upjohn Pharmacy, and he worked as an executive. You have 12 months. The only do-over is if you pay all 12 months back.
Yeah.
Cash.
Simple.
No payments. I've done this for 21 years, or 22, and I've only had one person that said that was simple because he made over 6 figures a year. So you'd have to be able to, his Social Security was $2,300 a month. He took $2,300 and took 11 months and 10 days and had to write a check and pay it all back, and then he was able to start. So I've only seen one example of folks being able to do that.
And that is only for 1 year? Because if you claim Social Security at 62, and you realize at 70 that you get a much higher amount.
You have 12 months to make that decision.
Can you pay back at 8 years?
No, you can only do it for 12 months.
Only 12 months.
Only 12. And I don't know anyone that could pay back 8 years. You have to have a lot of money. But if you could, that's fine. But the example is that they have written in the rules that you have exactly 12 months to write a check and pay that back. And then they can turn it off like it never started, and you can do it over. And I've only ran across one person that could do that.
Will be a higher rate when you do it over?
depending on what your situation is, yeah.
Keep on working?
Yep, but he told me when he came to me, do you know who facilitated the do-over? I did. He didn't know that he filed wrong. He kinda like my dad, he was an executive, he was doing a lot of stuff, had a suit on, I knew him from the country club, we golfed together, so he felt that he knew it all. I'm gonna file, I've got a big beautiful house. And when he did it all by himself. When he came to me, we sat and talked at a general conversation, he went, oops. Fortunately, he could do it over. Now, I talked to a lot of other people that went, oops, that couldn't afford to pay it back. Okay? You got a question?
So even after, let's say when you reach full retirement age,
Mhm.
you have 1 year to pay back the money.
You can only draw it for 1 year.
Yeah, before you say, I want to return what I get over this 1 year.
That's correct, yep. Yep, you
And
can only have drawn it for 1 year. In other words, you have a 12-month window. If you draw at 62, you have to turn it off, and there's a filing paperwork process, it takes 2 months to process as well. So now you're in a window of getting it in right away to make sure it's done right,
Yeah.
and Social Security office, unfortunately, isn't gonna walk you through that process. But it's possible, it is. So write that down and I can talk more about that, cause that can take us into a long conversation. But yes, that's that 12-month to do a do-over, but you only have one time you can do it, okay? But you have to have the cash. So, like I said, when should you start taking benefits? We don't know. We'll sit down and we can figure that out together. Let's talk about this. How will working impact your Social Security benefits? Okay, now this is where the wording gets different, okay? I wanna talk to you, I'm gonna fly through this, but you wanna catch the words on this. So for a couple that's 62 to full retirement age, in 2022, these are this year's figures. Last year they were different, okay? That's gonna be your income amount right there, that's the limit. The reduction if you make over that is $2 for every $1 withheld from your benefits. Now when you reach full retirement age, that's the income level. If you make over that by $1, you wouldn't pay that much for $1. But if you make over that, it's $3 over the limit, and $1 is withheld from your benefits. Now this is where it gets tricky, and the gentleman that was here the other night really played with these words. And that's tricky, I get it. There's no limit on earnings, and there's no reduction. But if you look at this says full retirement age, and that says full retirement age. But the word above it is the first one you read. So at full retirement age, if you make $51,960 this year, at full retirement age, you will be penalized then. After full retirement age, that's gonna be the amount, okay? So that's the trick. You have, that wording is I get it. It's interesting.
I still don't understand what the difference is.
Well, if you're 67 today, right?
Yeah.
Tomorrow you're 67 in 1 day. That's after full retirement age. 67 is full retirement age.
Yeah, but okay, that means that for that 1 month I have to pay.
That's the wording the government uses.
Nobody cares about that.
They do.
For the 1 month?
They do. It wouldn't be very much, but yeah, but they do.
Oh, okay. No, I understand.
You see what I'm saying?
Yeah.
Yep, it's important that people know that, okay? So, how will taxes impact your Social Security benefits? Well, for single, that's gonna be your circle. If you're single, that's the limits that you're gonna deal with, okay? Now, if you're married, that's gonna be your circle. Now, while you're looking at that, maybe writing it down, how will taxes impact your Social Security benefits? I don't know, but I can give you examples of what I deal with, with clients. The gentleman with the $250 in the bank, I deal with a lot of those people that have different amounts, $50,000, $75,000, $100,000, $250,000. We worked with the guy up in the Upper Peninsula with $500,000. That's a rare that somebody will do that much. But when somebody has, how will taxes impact your Social Security benefits? When he had $250 sitting in the bank or in a brokerage account, because Non-qualified money is money that you got paid, you already paid taxes on, you went to the bank or broker and somebody put it somewhere. And every year you get a 1099-R, and you pay taxes on the growth whether you take any money out of the account or not, okay? Okay, it's not tax deferred. Now IRA money, you never see it. You work at a job, or you're self-employed like me, and I have it taken out before I get paid, or your job, you have it taken out before you get paid and go into a 401k or an investment, and that money's tax deferred. Because you never see it. It's growing tax deferred. Okay, it's still in the market, making, losing left and right, and you can defer that all the way to age 72 and a half before you have to take a required minimum distribution. That's not what we're talking about. The non-qualified money can screw you up here because the money that's non-qualified is not growing tax deferred. You're paying taxes on the interest that you're trying to gain, and it sits in the column that adds to your taxes. It raises your taxes up. So what a lot of that non-qualified money does to reduce the effect on Social Security is to move some of that money to a tax deferred section. Because now on non-qualified money, if it's in an annuity, the right one, it's now tax deferred, which takes away the tax, it lowers the tax problems on your Social Security. That whole bucket changes. We can talk more about that later, okay? That's one way to do that.
This I don't understand so much, but that's very much.
Write that down, and I can talk with you about that.
What are you saying there at single filing?
Single filing,
Yeah, let's take that first example. Do you mean that 25,000, about 2,000 a month,
under $25,000 of annual income?
in addition to Social Security?
No, this is your single filing. So yes, in addition to Social
In
Security.
addition to Social Security?
That's correct. Yep, all this
So,
is in addition to Social
If I'm
Security.
single and 25 is about 2,000 a month, I can make $2,000 a month and still pay zero tax. Is that what I read here?
That's gonna be the penalty on Social Security. If you're making under $25,000, Social Security will now be penalized.
I still have to pay tax over the 25,000.
Right, this slide is.
But there's no penalty to my Social Security.
Right, this slide's on how
okay,
will
now I get
taxes,
it,
and,
I get
yeah,
it, I
do me
got
a
it.
favor, write that down, cause I wanna make sure you understand that, there's more to this slide.
Yeah.
But so we'll go through that, but this is showing you how to reduce the taxes on your Social Security, that's all. It's again, one of the puzzle pieces. How do we save one to the other and work them together? How do you bridge that gap, okay? So reducing or eliminating taxes on Social Security income. Well, you can postpone your Social Security benefits, waiting till you're 70 or your full retirement age. Either way, waiting to file or by suspending or claiming for late years, which is, there's many different ways to do that, okay? You can reduce your sources of income calculated in your provisional income. So you can reduce your income that you're taking from your 401k, from your mutual funds, from your investments. You can reduce the amount of money you're taking from your investments, okay? That you can do if it's an option. And the examples there, wages, you can work less. It's the only way to reduce that. You can take less from your IRAs unless you're 72 and a half, and then you have to. I had a client that texted me right before you guys came here and said, Greg, I have my required minimum distributions coming up here in March. How do we handle it? Because he doesn't need his money. There's ways we can actually use that with an annuity. We can funnel that through and still meet the requirement and do some things, so. Interest and dividends, you can take less on those. You can include earnings on tax-free municipal bonds. You can take less on capital gains. You can actually sometimes pay with your pension payments. Sometimes people can choose at the time how they want to get their pension payments and take different ones, sometimes, okay? You can, on an inheritance, you can choose to put it in a different spot. I just dealt with an inheritance outside of Ann Arbor. Gentleman owns a huge trucking company. His father died and he inherited $150,000. He couldn't take that money on, so he called our office and we told him until he's the same age as me, put it into an annuity, and then moved it so it didn't bother anything that he was dealing with, tax situation. Okay? The whole answer here is you gotta reduce your lifestyle. That's the whole answer, because if you're gonna reduce your income, you're gonna reduce your lifestyle. You're gonna reduce the things you're doing, how you're living, your daily routine. So that's what you'd have to be willing to do. You'd have to back off. You'd have to go from this is the money I need to this is the money I want. You'd have to go to need and forget the want. You'd have to play with that to do that, okay? And that's not what I'm here to have you do. Strategies that may enhance your benefit. Well, there's a spousal benefit. We can talk about how that works once we sit down. There's ways to play with the spousal benefit and play with the husbands. There's ways to leverage that and how you can, and you can use that benefit to protect your 401ks and your other financial assets. There's ways to do that, okay? Write that down, and those are reasons to get with us, to show you how to do that, okay? File and suspend. Does it fit in your situation? We don't know, but that's another avenue that can work. The do-over or the reset, we've talked about that. Again, I watched it happen one time. Is it a realistic example? No. I've known one person that was able to do it, to pay that full 12 months back. And there was a lot of paperwork we had to go to do that. It's just not filling out a paper, and then you make sure you have to get it in on time. Because Social Security doesn't care about the mail. It's not in their office at a certain time and the mail's screwed up, they don't care. Okay? It doesn't bother them. So there's different ways, but that is an option. Start, stop, and start again. We can talk about that. Spousal benefit options. There's going to be a couple options we'll go through here. Option one for an individual benefit. Okay, just one person. Each spouse collects their individual benefit. That's one. You do it separate. Okay. Option two is the lower earning spouse can collect up to 50% of the higher earnings full benefit and possibly a spousal boost on top of that. That's option two. Keep an eye on this. 50% is not truly 50%. The simple math, if your Social Security is $2,000, you would expect hers as a spousal benefit to be $1,000. It's not what's going to happen. Again, I go back to that funny joke, but it's true. I don't know what the new math is. 2 and 2 is supposed to be 5 down in school. Somehow they got 5 out of it. This math doesn't fit 50%. Okay? But that's what it used to be. When I first started this industry, 50% was normally 50%. But now with taxes and different stuff, they played with that. Okay? Options 3, there's a widow's benefit. There was a lady here the other night that was a widow. There was about there's quite a bit of our clients that we work with single women and single men to show them how to do that with their Social Security benefits to widows and widowers, that if you've been married, you've been divorced for 10 years and haven't been remarried, you can draw off your spouse's Social Security. They wouldn't even know about it. So there's different benefits out there. Okay. Some important aspects to know about spousal benefits. I'm going to kind of let you read through this. 62. If you elect to receive Social Security benefits before you reach your full retirement age, your benefits will be, this is key, permanently reduced. We've talked about that. Now, if you want to play with that and say, well, there's a do-over, you can, but there's not very many people that do that do-over. When most of the clients I sit with, there's a lot of them that wish they could have not been permanently reduced. Like your example's a valid point. He was 66 in 4 months and he didn't do it right. He filed earlier than 66 in 4 months and his Social Security was permanently reduced. He was 30 days away. He did 66 in 3 months. He needed to wait 66 in 4 months. If yours is 66 in 6 months, then that's what it needs to file. It's not the Social Security advisors at the other end to make sure that you file your paperwork right. It's not. We do that at no cost. We help you through that process. Okay. The next one, if you start your own regular benefit early and switch to a spousal benefit when you reach full retirement age, you may not receive the full spousal amount. If that's a question, write that down and we can go through that for you to show you how to piece that together. Social Security will subtract your full benefit from the spousal benefit and add the difference to your reduced benefit amount. The result could be less than 50% of your spouse's benefit. Okay? Again, these are things that work in a married couple situation, and it only works based on certain situations, based on what your situation is. Okay, does it make sense? Has anyone here been through a divorce at all? No good or bad? Okay, are you still single? Have you been divorced for 10 years? Is your 9 years. Is your ex-spouse still alive?
Yep.
Is he 62?
Yep.
Okay, then you could draw it off his Social Security, you wouldn't even know about it. Okay, so-
reading that, you know, and I even went to the Social Security office, you know, a few
And they
years
didn't know,
ago.
did they?
And no, they told me I couldn't do that.
This has been around since it was enacted.
So, yeah, and I thought that was true,
It is.
but,
If that's a question, write it down,
yeah,
and then we can help you through that process,
yes,
okay?
thank you.
So I'm gonna go through this, because not everyone needs to go through this. Survivor's benefits, if you're a widow or a widower, you're eligible to collect either, are there any, widow or widowers in here at all? No, okay, so we don't need to go through that one. Maximum lifetime in survivor benefits is critical. 54,900, 56,000 Americans are centenarians in 2011. That's a lot, okay? What that means is 81% of them are women. Isn't that crazy? 81%. Now, they live longer than us, don't they? They do. Women generally live long. Guys, we're a pain. We cause stress, we don't do what we're told, and they love on us anyways. So, I mean, it's amazing. And 19% of them are men. Now, here's where the puzzle piece people forget about. I want you to look at that and that, and I want you to look at this and that. Now, if a couple's drawing 2 Social Security checks, and the wife never worked, which my mom was a mother, she worked. She just worked at home. So she drew half of my dad's. She still does. Now, when my dad passes away, she's gonna lose hers. Oops. Now, I can tell you what, it doesn't cost any less for 2 people to survive than it does one. My experience in 22 years, when I see a couple pass away, one of them, for the first 2 or 3 years, the costs go up because the other couple's trying to figure out what the heck to do with their time. They go shopping more, they go out with the ladies or the guys more, they go hunting more, they travel. So if you can't replace their Social Security check, if you have money sitting out over here, and it's on a hope investment, and the market's been doing okay, man, it took a dump in 2008, 9, it's not doing real well, it goes up like a roller coaster. I hope it's there when one of us pass away. Hope is not a good word for retirement. I don't see that anywhere in accounting. It just doesn't fit.
Quickly, just for clarification,
Yep.
if I wait till full retirement age,
Yeah.
my full retirement, and then my wife would take hers a little bit earlier, and I die, would she get would she go up to what I received at full retirement of what I got?
Yep, and then she would
Okay.
lose hers.
Yeah, she would lose hers.
You always get the higher the 2.
Right,
Yeah, you would get the higher the 2.
okay.
Okay, yep, exactly. So,
Oh, I have a question.
Yeah.
Maybe a little bit related to this. Because Social Security also has this rule that the maximum payable amount is 170% of the Social Security you're entitled to. That means that your children and your spouse and yourself or whatever can only amount to the 170% of what you suppose, of your own Social Security. How does that work out in this?
well, that's a yes/no answer. I want to show you that answer in some of the, actually, there's some case studies that go over that exact answer.
Oh.
So hold that question, we're gonna go over a couple of those, and we're gonna answer that exact question.
Because that is puzzling to me.
Because the answer, and that's also one, and I'll answer some of it, but that also is the one that we'd have to talk more about, because we could rabbit trail on that one for a while.
Okay.
So I'm gonna try and answer some of that, but then write that down, and we can go through that, because that,
You understand what I mean?
part of what you said is current, and part of what you said isn't valid anymore.
Oh, okay.
Yep, so, and that's not your fault, it just is what it is, so, alright. So now here's where, okay, we aren't there yet, but this is an example of how the case studies are gonna go. Then we're gonna go through, I'm gonna cover 2 case studies, flip through the other ones and get to the last one, and you'll see the results of all of them, but you'll understand what we're doing. I don't wanna tie you up in the numbers of 9 actual active case studies, or real situations, okay? So the case study, how it's based on, is Mike and Rebecca, their personal individual annuity, which is Social Security, at $2,056. His date of birth was January 2nd, 1954. He filed that at 66 and 0 months. That happened to be what his time was, okay? 66 and 0 months. His expected death age through Social Security was 84.09. Okay, so he wasn't expected to get through one of those months, I guess, it's just 0.09. I don't know how they figure that out, they do. Rebecca, his wife, her personal individual annuity that she filed was 1,682, so she had her own crediting hours. She filed her own. She didn't have to file half of his, okay? This is one of them. She was born November 2nd, 1954, 66 and 0 months. Expected death age of hers was 87.01. Now, because male and female, she's expected to live longer. Okay, just is what it is. Now, here's a website. It's on there. You can go to it. My own personal feelings on it are there's no way to really know. This site's not going to know what's going on in your family. Okay, your family lineage. But if you want to generate, you can go to this and find out your expected death age and how to calculate statistically. Keep in mind, statistically is all this site's going to tell you. Now, you and I were talking beforehand. Your life expectancy, you'll know that a little better than I will. My great grandmother, she died over the age of 100. My dad's father died over the age of 87, 85. So it's, but that doesn't mean that that's my life expectancy. That just gives me an idea of what's going on in my family. Okay. So if you go to this website, you're more than willing to. It's a good site. It's statistical. It's not accurate. It's not going to be what's going on for you. So let's talk about case studies. These case studies are going to go through actual examples. And it's going to address, I'm not going to get into it in detail with yours. Write that down as a question, but keep in mind your question when we're looking at this, okay? This is where we're going to show you on filing wrong, or, well, I'll take away wrong. On filing in different ways can affect you. And not understanding how to file at the right time, how it can affect you. And there's a $150,000 difference in these examples, okay? And it's like Tiger Woods. He did an interview just a couple days ago, and he told you how he got really good. He didn't do it by himself. I don't know any of us that got good in our careers by ourselves. And Tiger Woods' son actually out-golfed him on a father-son tournament a couple weeks ago. Out-golfed his dad. And when they asked him, how did you do it? He said, well, I had a good coach and I listened to him. And that was his dad. And Tiger Woods will tell you he had a coach that he listened to. So keep in mind that. So let's go through these two here, and we're going to skip through the screens and go to the ninth one. Okay? But you'll get the understanding of it. Mike and Rebecca, their first strategy. They both filed in 2024 on their birthdays. January, Mike files for the worker benefits in his annuity for $2,713 at age 70. See, now he delayed it. Now here's what I want you to hear. At 132% of his personal index annuity. So by him, in his situation, he waited till age 70 in his personal indexed annuity, or individual annuity, which is a Social Security account, 48 months delayed on his retirement credit. He was able to get $2,713. Rebecca did the same thing on filing, followed his path. And hers was $2,220. The difference is now her widow's benefit is $2,713. Because when he passes away, she's going to get that. And if she passes away, he keeps that. It's the higher of the two that stays in the marriage. Okay? So keep that in mind. I'll go through the second one. There's a little bit of a change here. Now Mike and Rebecca filed November 2020. Files for the worker benefits. It got $1,682 at age 66 for only 100% of the personal indexed annuity. Okay? And Mike still did the same thing that he did up here. He didn't change. Now the difference in strategy 1 to strategy 2 is strategy 2 over the course only made $944,925. There's a $10,000 difference there. So by how they filed there, they made $10,000 more in strategy 1. okay? That's what they did, all right? That doesn't mean all these strategies are gonna work for each and every one of you, okay? We're just gonna show you the effects of not understanding what strategy is gonna be best for you, okay? We're gonna fly through, we're gonna get to the last one here, okay? Now we're gonna go right to strategy 9. And I'm gonna cover all these while we're on here. All these are different type of examples, and we'll cover 2. Mike and Rebecca in strategy 8. Mike filed in 2016 for his worker benefits. Instead of getting $27.13, he got $1,550 at age 62 in 1 month for only 75.42% of his annuity. Okay? But again, maybe that's what they had to do with a 47-month reduction. Okay? Rebecca files for her worker benefits and got $1,682. Same thing. She's been doing, she did, on the second example before, November 20th. She did the same thing. Hers stayed pretty consistent back and forth for $1,682 at age 66. And if you notice here, there's a difference in it. His went from $27.13 to $1,550. So now she doesn't have a widow's benefit in this strategy. Why? Why does she not? Now in this example, you see there's a widow's benefit.
Yours is higher.
You're right. Hers is higher. So there's no widow's benefit there because hers is higher than his. So there's no widow's benefit. There's a widower's benefit. Now if the wife passes away, the husband would then get that. But our statistics would tell you that that normally doesn't happen, and normally it doesn't. But it can, and it has. Okay. Now if we go to the last one, you'll see here. Mike files in 2016, $1,550, 62 years old, 1 month. Rebecca files, oh, well, this is different. November 2016, Rebecca files for benefits of $1,214 at age 62 instead of age 66 for 75% of her personal individual annuity at 48 months reduction. Her widow benefit now is $1,550. See, the widow benefit only exists if the husband's is higher. Otherwise, it doesn't exist. Okay. So the effects of not working with someone to walk you through this. This is the actual effect of it. Okay. You can go from strategy 1 all the way to strategy 9. There's a $150,000 difference between those. Now, it doesn't mean that any of these are wrong, because some people have to take these strategies in the middle or in the front. But it's having someone to work with to help you understand what strategy is going to work for you the best. Because that do-over, most people can't write a check for it. And I wish that people could, because I've watched a lot of situations where if we could have done that and they could have afforded to have done it. Because then what happens is for the do-over generally, is most people have to take it out of their investments, right? You would agree? Well, then they have to pay taxes. Or they have to take a penalty out of their IRA. So now they got to take it out of an investment to pay the do-over, and they're paying taxes on the money they took out, which raised up their income to pay Social Security back, and they got taxed on what they had to pay back. So they get taxed twice on doing the do-over, which is what happened with the gentleman. Because he had to take it out of his investments to pay it back. Because most people aren't going to take it out of their liquid money. If you have $100,000 sitting in the bank or $50,000, and you have to pay back, $30,000 or $40,000 to Social Security or $25,000, whatever your amount is, you're not going to take out of your $50,000 in savings to pay back Social Security, because that's your anyway emergency money if something happens. That's your old poop money. So you're going to pull it from somewhere else. So, that's kind of what that is. So now what? Will I outlive my money? Is anybody willing to share if they're afraid to outlive their money? Has anyone got that concern that they're worried to outlive their money? You don't have to. That's about a 59 to 60% concern right now nationwide. Will I outlive my money? Okay. What are your current income needs? There's a difference between what I want and what I need. When I sit with couples, I go, how much do you need? We write it down. There's usually a significant difference between what they want and what they need. Okay? they have to figure out first, what do you need? What do you anticipate your retirement income needs will be? I've been doing it for 22 years. I can tell you things change to some extent, even if your bills are paid off. You know, let's hope that when you get to retirement, you have no debt. You have absolutely no debt at all. I mean, let's hope that you do that. And you've had no debt for 5 years before retirement. And you know what your budget's gonna be, you got it put in place. And maybe for the first couple of years, it's gonna raise because you're traveling, seeing the kids. Now you got extra money, you're paying for weddings and all these other things. So some of it goes up, some of it stays the same. But you gotta be prepared, what your income needs gonna be. How can I close the gap between what my income needs are and what I want? So that's where the gap is. I mean, right now, if people are working, there's an income lifestyle that they're used to. And there's a low percentage of the people that I deal with that would tell you, I'm willing to lower my lifestyle when I retire. There's a very low percentage of people that would say that, even if they know they need to. They're hoping that they can figure out, there's that key word again, hope, that they can figure out how to look at their estate and change the picture to maintain their lifestyle. And sometimes there's an answer, and sometimes there's not. Either way, there's an answer. They just sometimes like it, and sometimes they don't, okay? Maybe it requires them still going to work. Maybe it requires them moving money from one pocket to the other. Maybe it requires them selling a big house, going to a small house and living in it. So you just have to be willing to do what you know what the difference is. How do you bridge that gap? And that's what we're gonna do as an advisory firm to help you figure out how do you piece that together. So what are your current income needs? There's a sheet in there, okay? When we get together, now I've told you I'm pretty frugal, right? I'm a frugal guy. I'm Polish and Dutch and I save money, okay? And if you look at the front of your folders, it's kind of funny. On the very front, there's a sticker there. And that's my business card. I'm so frugal that I don't even give you business cards. I give you a sticker. So I like to save money. I practice what I preach to my clients. So I want you to save that sheet so when we get together, I don't have to print another one. But if you do, we'll print another one. Okay, you're going to want to fill that one out. Okay, that one's not tonight. Save that for one before we get together. Okay. What do you anticipate your retirement income will be? That's what that's for. To look at what do you think it's going to be. And sometimes you can do that by yourself, and sometimes you need a second look. It's like going to one doctor and then having another doctor tell you something and give you a different perspective. Okay. Most retirees require 80 to 90% of their pre-retirement income to maintain their lifestyle after they stop working. 80 to 90% of their pre-retirement income. Now that doesn't include Social Security. It's pre-retirement, their income. And how many people's pension is exactly the same or under salary? Very few of them. Okay? So how do you bridge that gap? You're hoping to do it with Social Security. Okay? How can you close the gap between the income you have and the income you need? And what other sources of income do you have? I don't know. That's what that sheet's gonna help us figure out on where the puzzle pieces can be put together, okay? So, you know, here, this is the second part of the pieces. You've got Social Security as a puzzle. I love puzzles. My wife will tell you that. I don't like the ones with 1,000 pieces. I like the ones with 10 pieces. They're easier to put together. But I can work with different both. I have clients that I work with that have 40,000. I have clients that I work with that have 4 million. And I'll tell you what, it doesn't matter how much money they have, they all get treated the same. Nobody gets treated different. They all get the same treatment. So your retirement accounts, this is what your retirement accounts are. You got a Roth IRA, you got IRAs, 401ks, 403bs. And those right there, it's all, other than the Roth IRA, those bottom three, it's all the same money. They're just different tax titles for different jobs. Okay? Now, when you had a 401k at your job, if you reinvested it somewhere else, it turned into an IRA by itself. It just turned into a SID IRA. If a 401k goes into an annuity, it's an IRA and it's still the same money. Now it's just not going to go backwards. You're never going to lose it. Unless it's a variable annuity, which the title itself tells you what that means. It varies. Okay, you pay about 3 to 5% to own those. Defined benefit plans. Well, Those are fully funded by the employer, not the employee. They're simple. Their benefit is a known amount, only one plan. You know, you don't really have a say on what you're investing in if it's a defined plan. And most are inflated adjusted and they're fully taxable. So if anyone has a defined plan, they're fully funded by the employer. A lot of people, you know, 401 or pensions right now. I was talking to a gentleman here before, and I'll tell you the same thing, that when my dad was working, and maybe when you guys are still around there, pensions existed. Now they've kind of died off with the dodo bird. I've got friends that are high executives at Pfizer that had a small pension when they started, and it got taken away in 2008 and 9 and turned into a 401k. They took it away. It was gone. Okay. I've had very few people that were retired out of Battle Creek, and they had a pension for 7 years, and they lost their pension because their company went bankrupt. And they just, boom, so they lost their pension. They didn't control that guaranteed income for life. So their pension wasn't a guaranteed income. They hoped. That rarely happens. But again, control the controllables and deal with what you can. Okay? Investments, if everybody, you know, everyone's got different investments, CDs, stocks, bond, mutual fund CDs. Those are subject to reinvestment risk. There's no guarantee on principal or growth. Earnings are usually taxable and principal protection is limited. Okay? So if you're dealing with, if you got 401ks, this all is going to affect your Social Security stuff. When that hits that one bucket, whatever this money's coming out of, it's going to go into a bucket. And your Social Security is going into that bucket as well. So however this money comes out or not, that's going to affect your Social Security. And if you're losing money on these investments, it's normal. It's the market. You can't control it. You know, having been a broker in the past, the hardest thing to do is when people come to my office and go, Greg, why did I lose money? They thought it was my fault. Now I could call you and put everything in fixed and you'd be angry because you only made 2%. Except in 2008 and 9, when all of my clients were in equity indexed annuities and nobody lost a dime. And the average growth was still 4%. They weren't too unhappy about that. But what people are excited about is when they make that 20%. And then the next year they lose 5%, and they lose 10%, and they come up and they make 18%. The only thing they talk to you about, I made 20% in 2008. Do you remember that? I made 20% in 2012. Do you remember that? They don't talk about the years they lost 22%. It's normal. It is. But if you could figure out a way to ride a smooth boat, you know, what's that old thing my grandma used to tell me? This, you know, steady and slow wins the race. If you go up a mountain, it's easier to go up on an angle. Have you ever been skiing? When you go over to Timber Ridge, the lift goes up on a smooth basis. It may take longer to get there, but I'd rather do this than to go up and do that and up real fast and down. It's a smoother basis and you get there quicker. So you gotta figure it out. We're almost done. Annuities and deferred or immediate. Really fast. If anyone has annuities, or you've had annuities, then you may understand these. But the ones I did 20 years ago and 10 years ago aren't the same as the ones we do today. We still generally operate the same, but there's some different growth vehicles and things. So one is a variable annuity. That's simply a 401k or a stock product with a pool of mutual funds that is getting washed by about 2% generally. And there's no guaranteed growth or fall, that's fine, we all do that. They wrap around a death and mortality expense and charge you about 2 to 3%. It's a life insurance policy that says that if you invest $100,000 in a death that's worth $75,000, you pay 2 to 3% for all those years to at least get $100,000 back to your beneficiary. It does nothing for you, it's for the living. Okay, and those used to be good vehicles. They did. Business owners loved them. I was one. But they don't work well for us anymore. Okay, they used to be. Okay? Immediate annuities, banks used to love them in the 70s and 60s, even the 80s. You know, it'd say, you know, Daryl, you just retired, you've worked hard, you've got $300,000, you don't need to pass it on to your kids, good grief. Let's pop this thing into an immediate annuity. We'll give you a period certain on that, and if, as long as you live 20 years, you'll get all of it. But if you die in, any time in the middle of that, your wife or you get none of it. The immediate annuities have changed. That's what they were like. Now it's just simply if you do an immediate annuity, you just pop it into it, you buy it because you don't have a pension. And I don't do immediate annuities. I can, but you can do them with indexed annuities and get options and create a lot more ownership and flexibility. But immediately when you just pop it in and you don't have a pension, you just retired, and we turn your income on right now and you got a pension. The same thing your company would do if they offered it. Okay, and if there's not a lot of interest or growth, you're gonna get the cost of living, which is about 1.5% to 3%. You're not gonna get any growth in the market. The insurance company keeps it on the immediate annuities. And once you turn them on, you can't turn them on. Okay, no options, things like that. On the equity indexed annuities, they're fixed annuities with options. I'm not gonna get into all the details, but the fixed annuities right now, your effective rates are about 6.5%. We just did one a couple days ago at 7.2. I only work with A+ rated companies, and we work with the top 5 in the nation. They're built. We're called the annuity architects for a reason. One, we're Social Security certified as an agency. We have a department that does that, and everything we do has to fit whatever you decided that wants to do it. I'm not going to do this where the bank told her what her goals was, and she went home and changed it. We're not going to do that. Okay. So that's there's more to it, but that's really what they are. There's a protection from lower interest rates. There's tax deferral on earnings. Remember I talked about your non-qualified money. If it fits right, you can get tax deferral. Some people have non-qualified money that they don't know what to do with, and they want to create legacy, leave it for their kids or a church. That works great for that, but there's a lot of different things to do. No mandatory distributions at all. You can leave it there forever, but you can still get access to it. And no, there's not 400 annuities. Those are it. Okay, that's all there are. There's a guaranteed income for life that you can get. It's a pension. The cool thing is you can turn it on when you want. You have to wait 1 year generally, unless you buy an immediate annuity. There's not as many interest growth. It doesn't make as much money. But if you have to right away, but normally we can sit down as an agency and figure out how to get you the best one and get you through that year comfortably and not even around the news.
With a guaranteed income for life, if one of the spouse dies, will it go to them?
Yep,
Okay.
just like a pension, and
Just
you
like a
control it.
pension.
Yep.
Alright.
And if you're like me and have a special needs child, I can even pass it on to my special needs child. And an annuity is protected from probate. I understand trust. I deal a lot with that. I'm friends with a gentleman also who runs 36 different care centers. The flagship is out of Lawton. He's a friend of mine, so I understand how to protect money. Annuities protect money from nursing homes, 401ks, and non-qualified money. So there's planning that we do to help with Social Security. If someone goes to a nursing home, where's their Social Security check? Goes to the nursing home. Yours would go to the nursing home. She has to stay home and figure out how to pay the bills. So the planning that we do to bridge that gap, my biggest challenge is to help you guys look down the road. I talked to a gentleman today that invested $40,000 into that pesticide settlement. And I called him back and I brought up the concern that if he died, he was gonna lose his Social Security check. And he had $190,000 sitting in a brokerage account and $90,000 he was playing with, and never thought that he didn't have life insurance and didn't know how he was gonna replace his Social Security if he were to pass away. So $90,000 bought him $20,000 of life insurance for both him and his wife, and bought him an annuity that's gonna give him a guaranteed income for life because he doesn't want it if he passes away in life insurance. So all these things that we look at, it's all about playing pieces of puzzle. That's what I do for a living. I put puzzles together. Okay? So yeah, that income is guaranteed for life, and annuities by themselves are protected from probate. They act just like a trust. It's an insurance contract. Okay? Permanent life insurance, as we're wrapping it up, really, the insurance company that we work with, a very large one, they told me that, Greg, you're starting your presentation backwards because life insurance really is the pinnacle of everything, and it really is. Everything starts with life insurance, or some sort of insurance. So we do deal with that as well. There's different policies. We can have income-free loans and withdrawals, up to cost basis. There's no penalties for early withdrawal, and there's no minimum, distributions that are required. Having said that, generally the people that we work with are already set with life insurance, but there are some new options now because of COVID. I don't know why the insurance companies decided, but it's a good thing they did. There's some new options for older people that never used to be there before. Because generally folks that want life insurance can't get it because of their health. And folks that should get it won't buy it because they're Superman and not gonna get, and they're never gonna get sick. Or they've already got a good company plan, which we don't mess with. So creating a plan for sufficient retirement income, that's really what we do as a company. You know, when you came in here, I asked you, why did you come? You could have stayed home and watched Seinfeld or whatever else you were gonna watch on Netflix and, you know, binge watch TV and all that stuff. But for some reason you drove out in the cold and you came here to listen to this goofy guy talk to you about something, assuming I was gonna probably try and sell you something. But I'm hoping that you, whatever you came here for tonight, to learn, that you got answers. Now there's that back survey sheet in the back. I think it's right there in that back one. Yeah, make sure you fill that out tonight. It's important that you turn that in. It's important that you give that to Jenny on the way out. It's important that we get together. And I am gonna really edify this, because we're watching things happen in the United States today. And whether you do anything with us or not, it doesn't matter. You'll at least get some information that you could walk away with and improve your situation. Because we're gonna go through whatever concerns you have and show you after we've x-rayed your situation, and we're not charging for it. You're gonna wonder, how do I get paid? I'll tell you how I get paid. You know, most advisors won't until you sit down, but I'll give you a window. None of you guys will ever write me a dime, and it won't come out of your assets. The companies I represent take care of me. That's why I work as a 501c3. The companies I represent pay me one time. But, you know, why would you go with our company? I talk to our clients every quarter. Phone, text, Zoom, in person. That's not a once a year thing. We do so much planning outside of this that's gonna help you grow in your estate. We help put together a total retirement plan. And we don't charge for that, okay? You know, as we've talked tonight again, how many people learned something different than what they did when they came? Did anybody learn anything new? Did people learn something new? Okay. And that's really what I want you to know, that I was wanting to make sure you did. And I wrote this down because I wanted to make sure it was important. Is there anything that you didn't know that you learned tonight outside of what I just asked? Did you identify why you came, or is that still not clear? Because for some reason you came here tonight. Some people are getting ready to retire. Some people watched the news and they got scared. Some people are just curious and they wanted to learn more. And some people are actually interested in change. Now, as I wrap this up tonight, that feedback is important. Fill that out. Set up a time. I'm going to give you a call tomorrow. I openly let everybody know that I call everybody that came to my events. So I'll call you tomorrow and verify the appointment or look to set an appointment. Thank you for coming and get your feedback on that. We're opening up, because we had a big night Tuesday, we're opening up the next 2 weeks starting tomorrow for everybody that either signed up for the seminar. Some people actually double booked and called my office today and wanted to get together anyway. So we're gonna do this with them individually because they double booked. Obviously, we do that. But for the next 2 weeks, we're gonna be open from 9 to 5. So circle that stuff down and see where it goes. But, I wanna get your feedback. All of this stuff matters. Your opinion matters, your trust, and your time. All that stuff matters to us, because that's how we can teach the next class better, okay? So with that, the last thing that I'll leave you with this, and I'm actually done. My wife keeps waving at me, because I'm kind of a shy person, and I don't talk very much, do I? So, I'm gonna leave you with that. But the only thing, that I know is that for the best situation that I had for planning, that I've got clients over the years that I work with. And there's a couple, some clients I work with become family, because I'm pretty honest and straightforward, and I don't have a lot of bells and whistles, I just do the best I can. There's a couple I started working with back in 2008. And they live in a little town called Athens. And they came to me when he retired. He had a house out there, and I never sell annuities in the first visit. Never. I never do it. I always go for a second visit and actually go and think about it and we learn and stuff like that. But this couple came to me and they had just been married, both second marriages, they were retiring, and they had no planning at all. Their kids chose not to know how to do any planning, and that's okay. They had no planning, they had no will, they had no trust, they had no long-term care, they had life insurance from the company that they're retiring with, and they had their health benefits. But they had all this money and they didn't know what to do with it. And the only guaranteed income they were gonna have was gonna be Social Security. Well, let's fast forward today. Today, he's getting home care, he's got Alzheimer's at home. What did we do before that I didn't charge him for? We helped him set up a trust, and I got him a discount through our law firm, which would have been $3,000, they got it for $1,500. I went to the law firm with them and sat quietly. They asked me to do it, and we set him up with a trust. They didn't have any long-term care. I don't generally sell long-term care because I can do that through the annuity if we do it right. Because I can get great commissions off long-term care, but why charge it to you if I don't have to? But these guys needed it, so we got them long-term care. They didn't know anything about how to protect their house from seizure. There's a little law that can protect your house from Michigan taking your assets. I knew that. So I helped them set that up. I didn't charge them. We looked at all their situations on when their husband was gonna pass away, and then they're dear friends of ours. And we've got everything set up. Their kids met me about a year ago, Jenny and I, 2 years ago actually, when their mother had a knee problem and slipped and fell. We met her at a rehab center on Borges. It's a rehab center there behind the little gym center there. And when the kids met me, they came up in tears. And they gave me a hug and they just said thank you. Because now they came to us with nothing set up. We have 4 guaranteed incomes set up for them, both in different names, on top of their pension, on top of their Social Security, with plenty of money liquid outside of that. There's a trust set up. We found care for them to stay at home, so the husband can stay at home. And we got a deed protection program to protect all their assets in their house, so nobody can take anything. So when he passes away, Janice will be safe, and her lifestyle continues on. I tell you that because that would be a reason why you might want to consider sitting with us and handing that in. I did that because I've been through it, so, personally. So on your way out, give that to Jenny. Let's book a time to get together. Whether it's your house, Bigby, or my house, and I appreciate you coming.
Thank you for coming.
And we'll see you guys. Oh, the last thing I'll let you know is there's gonna be a, what do I call it, a drawing out of both meetings. For everybody who sets an appointment, I'm gonna go ahead and do a drawing. There's a $50 gift card we're gonna give you. So, other than that, we're all done.
Thanks, Greg.
Thank